Good morning, everybody, and welcome to another episode of the Tip Share. Today, we're going to be discussing one of the most important tools in restaurant accounting, and this is going to help you effectively manage your food cost. It's a declining budget. And when used properly, a declining budget can be one of the best tools for stabilizing your costs as well as increasing your cash flow. So let's get started. What, in fact, is a declining budget? A declining budget is used in the restaurant industry to help controllers and operators manage operational costs. More specifically, the relationship between sales, your revenue, and the amount spent in relation to those sales. Ultimately, a declining budget will support the management in monitoring variable spending and fluctuating sales. So there are two parts of a declining budget, and in order to grasp how this very specific budget is used, we must first identify these vital factors for its success. First up, we've got restaurant sales. This is your revenue. So factually, we all know that restaurant revenues are variable. Many restaurants obtain their revenue from multiple revenue centers with dining room, bar, catering, banquets, and retail is the most common. Each week, the sales from these revenue centers can vary widely based upon seasonality, weather, holidays, sporting events, construction, and even new competition. All right, number two, we've got product pricing. So what affects product pricing? Product pricing, we also know, fluctuates tremendously, again, based on seasonality, availability, your purchase quantity, the quality of the product, and your total purchases made with a specific vendor. Additionally, we all know that products have varying shelf lives. This can range from 1 day for produce to indefinite for items such as paper supplies. Now, it's easy to budget how much you're going to spend and ultimately make when both the revenue you bring in and the product costs are static. But that's simply not the nature of the game. So let's talk about two examples here of what to do versus what not to do. Example number one, we're going to start with what not to do. Let's say we've got monthly sales revenue of $20,000 for week 1, $17,000 for week 2, $15,000 for week 3, $14,500 for week 4. So if we're looking at these sales above, we know we're off $13,500 in revenue from the first week through the fourth week. That's $20,000 minus your $14,500. So that's where we're getting our $13,500. You following? So now what happens if we spend the same amount of money buying our product each week without actually knowing that we should reduce it based on the sales? So here we go. We've got week 1 through 4, and we're spending the same amount, $10,000 every single week. Now let's check out our monthly cash position. Week 1, we've got that $20,000 in sales minus our $10,000 in product costs, leaving us $10,000 cash on hand. Week 2, $17,000 in sales minus our $10,000 in product costs, leaving us $7,000 cash on hand. Week 3 sales, $15,000 minus our $10,000 product costs, $5,000. Week 4, $14,500 in sales minus, again, our $10,000 in product costs because we're spending the same every single week with our $4,500 cash on hand left over. So let's think about this. Our total cash on hand is $26,500, but we spent $40,000 in product because we're spending the same each week without adjusting based on our sales. That means we've already overspent $13,500 in one single month. So if you were to use a declining budget, it would give you the ability to keep one eye on the fluctuation in your sales and the other on how much you've spent in relationship to those sales. That word is key here, in relationship. So as we mentioned before, if you're using this daily, this is going to keep your variable spending in line with your fluctuating sales. Now let's look at example 2, what to do. I'm sure you all can guess, our declining budget. So in the example below, we are stating the following. Our total budgeted revenue is $85,020 for the week. Our total budgeted spend, $22,279.64 for the week. Our current revenue is $78,078 for the week. Now this means that we're off in revenue by $6,942, or that's 8.2% for the week. because we've got that total budgeted revenue of 8520 minus our current revenue of 7878, and that's where we're getting that 6,942 number from. Now let's look at our spend on cost of goods and paper products. We've got 17 grand 818 for the week, which leaves us 4,461.59 before we're exceeding that budgeted spend for the week. We've got that budgeted spend of 22 grand minus that 17 we've already spent, and that's where we're getting this 4,000 number. So now if we're going to dig deeper into our costs, we can look at our produce. We've got 513.39 remaining before we've exceeded our budget, whereas meat, we know we've already exceeded our budget by 114.09. By adjusting our total budget revenue in real time to correlate with actual sales, we can see the adjustments to our spending targets and adjust ordering behaviors accordingly to hit our budgeted goals. So now that we just looked at an example of a declining budget, let's see how it actually works. Each day, your sales are updated and your purchases are recorded. Then, the total purchases are summarized and subtracted against your forecast. Simply, this results in your available amount to spend. So what happens when you spend more than your budgeted amount? Obviously, you shouldn't spend over your limit, but when you do, it can typically mean one of a few things. Is your revenue forecast accurate? Pay attention to your daily sales and make adjustments. Not doing so places your operation in a bind. For example, if you notice that your week is busier than usual, but you don't adjust your spending accordingly, you might not order enough product to satisfy all your hungry guests. Are your targets reasonable? Can you truly run a 33% food cost when you've been averaging 38%? It is absolutely necessary to be realistic in your expectations. Targeting too low won't allow you to spend enough on product in order to service your forecasted sales, even if they're accurate. So again, you have to be realistic in your expectations. Lastly, do you have the gallon of gas syndrome? You forecasted your revenue properly and you're ordering the correct amount of product, but you're still overspending. The gallon of gas syndrome simply means you can only go so far with what you have. Remember, product prices are volatile, especially on produce, dairy, meat, and seafood. They change weekly. Staying disciplined and following a declining budget enables you to notice pricing fluctuations on key items. In turn, this allows you to work directly with your vendors proactively on procuring the highest quality products while sticking to your budget. And here's a little bonus for you. A good rule of thumb is to forecast on a Monday and make your adjustments on a Thursday prior to placing your weekend orders. Thanks so much for your time, everyone. And you can get a basic declining budget template. It's an Excel spreadsheet download. It is the basic version of a declining budget on RASIUSA.com in our declining budgeting blog. And this will get you started and at least give you a sense of what you need to start taking charge of your finances. Thanks so much and have a wonderful day.